Today what I plan to do is the so-called financial alphabet soup or the structured alphabet soup. I will not try to explain a lot of the material. All I will try to do is essentially introduce terminology and introduce concepts that are used in finance, and more specifically that are used in structured finance. And these concepts are those that will be necessary for you to actually understand the credit crunch. These concepts come in a number of categories. The first category will be structured finance instruments. Then there are other money market instruments. These are not instruments of structured finance, but were essential instruments in the development and the growth of the credit crunch and the credit crisis. So you have to understand those money market instruments too. Then also have a couple of institutions and some mortgage terminology. So let's begin with structured finance. Now, the other thing that I will not do today is explain what is structured finance. This is the next lecture. The next lecture will provide an overview of what is really structured finance. And a couple of lectures after that I'll do on topics specific to structured finance, such as collateralization and securitization and so forth. So some of the concepts that you'll hear today will entail later in the course a full, complete lecture that will provide the details. So the first concept, which is the most popular, is called asset-backed security. A lot of times authors will simply say asset-backed securities, but much more often you will be simply seeing in the literature ABS. So ABS stands for asset-backed security. So what is an asset-backed security? This is a security, this is a financial instrument which an institution issues, and that instrument is backed by, or we also call it collateralized by, some asset. These asset-backed instruments are usually collateralized with other financial instruments. Not always, but usually they are with other financial instruments. For example, you have a car loan, and let's say the investment bank uses 1,000 car loans. It merges them together, it packages them together, and these 1,000 loans collateralize with that particular asset-backed security. So, asset-backed securities have a number of different varieties. Alright? So that's the most general. The definition that I've developed for you out of actually Wikipedia is these are bonds or notes. And here's the second key part. In all of these structured finance instruments, they are always concerned with a pool of assets, or pool of other bonds, or pool of other, let's say, notes. So, they are bonds or notes based on pools of assets, which are collateralized by the cash flow of a specific pool of underlying asset. So, what does collateralized mean? Well, it simply means that it's backed and secured by it. I will get into the lecture of securitization, a full, complete lecture, well, I'll be explaining a lot more. Alright, the next major concept is an MBS. And an MBS stands for a mortgage-backed security. So, an MBS, one easy way to think about an MBS is that it is an ABS, which is an asset-backed security backed specifically with a mortgage. So, this is a one type of ABS, and that particular type of ABS is mortgage. You probably know, you've heard, you understand that the crisis that started in August, well, it was before that in February, started because of MBSs. In other words, when you hear, and I'll be explaining later, subprime, when you hear the subprime crisis, what the subprime crisis was mortgage-backed securities or an asset-backed security with a subprime mortgage. When I get to the section of mortgage terminology, I'll explain what exactly subprime means. So, MBS is with a mortgage. The mortgage may be prime, it may be subprime. I will be explaining a little later today. We move on to the next one, which is CDO. CDO is one of the other major instruments. It provides a family of other instruments. CDO stands for Collateralized Debt Obligations. And a collateralized debt obligations is effectively, and this is very important to understand, today it is very important to memorize, next time I'll be explaining, is that it is a result or a process, as a result of the process called securitization. Now, roughly speaking, securitization is basically the process of pooling a large number of similar assets together. Similar assets is, let's say, mortgages, 1,000 mortgages, put them together, and these provide one security. Another example, you pull together student loans. U.S. government is essentially stimulating student loans. So there are institutions that are underwriting student loans. You get 1,000 student loans, you package them together, and they run as one security. Now, that's a process of securitization. I'll be explaining again a lot more about it. So CDO will represent a general category for securitization, which is collateralized. So, another key word is here collateralized. The collateralized usually indicates a process of securitization. Usually, process of securitization. Now, here is the other key word. The other key word is debt. So, this is a product of Wall Street. CDO is the product of Wall Street. What Wall Street does is get a whole bunch of debt, and through transformation, pooling and everything together, it makes a security. The way the credit crunch developed was that Wall Street was getting a lot of mortgages, most of them junk mortgages, which is called subprime of low quality, and through the magic, which is called alchemy of Wall Street finance, it was converting them to top-rated securities that got AAA ratings. Incidentally, I will have a separate lecture on credit ratings, how they're designed, how they work, what they mean, because credit ratings were instrumental in the development of the subprime mortgage boom, now turned into a bust and crisis. So, what Wall Street does is take debt and turn it into treasure. Taking debt, converting it into an asset. Alright? So that's the key of securitization. Alright, so another example, and let's try to do this. Out of CDO, one variation, one specific security, specific type of a CDO is CMO. And CMO stands for a mortgage. So it becomes collateralized mortgage obligation. Well, It sounds very similar, almost the same as MBS, and I will explain the difference in a few minutes. The characteristic here is called pass-through. So, the MBS and generally the ABS are pass-through securities, and these with the CDOs, CMOs, CLOs, etc. are securitized. And I will be explaining, when I finish this list, I will be explaining the difference between these two. Alright, so what's the next one? The next one is CPDOs. CPDOs, the key word here is a bond. So, you take bonds, you securitize the bonds, and you get a CPDO. So, a CPDO, another definition, is a CDO made of or composed of bonds. So, this is a special type of CDO based entirely out of bonds. This one is entirely out of mortgages or mortgage bonds. Okay? So, the next one is CLO. CLO, the letter L stands for loans. Now, loans, CLOs haven't gone bust yet as of today. January 25th, 2008, CLOs have not yet busted, but they are. What will be happening over the course of this year, we're most likely going to see the CLO industry go technically bankrupt. So, I will be explaining a lot more in this course. Now, what are these loans is the question. So, these loans, number one, are car loans. So, what usually happens is the automotive industry usually cranks out a lot of car loans. You guys gotta understand that the main business of GM is not producing cars. I mean, do you guys know that? The main line of business is financial services of GM. GM makes 90-95% of its profits from financial services, from loans, and a tiny percentage is from the car business. In other words, the financial business of GM now swamps, or let's call it dwarfs, the auto business, and from an automaker, GM has converted himself into a financial institution. Anyway, the point is, you have GMAC, which is the financial arm of GM, and also a whole bunch of other institutions that are generating auto loans. In other words, they provide a loan or a credit to a consumer to purchase a car, and they take these loans and securitize these loans, and a package of these loans creates a CLO, alright, collateralized loan obligation. What other types of loans do the trick? Well, the second big one is student loans. So, student loans are the second big one. So, you got a lot of students in the US that actually borrow to pay for their college. So, whoever lent them usually takes those, securitizes down the road, and they become yet another CLO. So, student loans will be the second one. And the third big one, it has not gone bust yet. There are very good reasons. I'll be explaining down the road why it hasn't. I actually think that Peter Schiff explained that really well last time. Anyway, these are credit cards. Meaning, credit card loans, the same thing as a loan given on a credit card. So, when you have a credit card company, finance company, or a classical bank, and it creates a bunch of credit card loans, when it generates them, it takes them out, separates them in a separate security. That security will be a CLO backed specifically by credit cards, and sends it out, and maybe a pension fund, maybe somebody else. So, in general, the basic idea probably I missed is that all of these, ABS, MBS, CDO, CMO, CBO, CLO, all of these instruments are ultimately bought by some sort of an investor. Of course, it could be a speculator like a hedge fund. It could be a pension fund, that will be an investor. It could be an insurance company. In other words, these are instruments that finally end up in somebody's portfolio, investment portfolio. All right, let's see what else we have. We have finally credit derivatives. Credit derivatives is a very large component of structured finance. Let's see if I have a fairly good definition. Are contracts to transfer risk. So credit derivatives are about, and as you get to read later for your second exam, Doug Nolan, you will keep reading because he constantly repeats over and over again, probably hundreds of times, is risk transfer, which he also calls risk intermediation. Risk intermediation. What does it mean? It means that if someone bears the risk through this credit derivative instrument, he's able to shift the risk to someone else. Now, I can probably backtrack a little bit for those of you, I assume most of you have had money and banking course. If you'd remember that the main purpose of financial institutions was financial intermediation. Financial intermediation was those having savings and investable resources in surplus. Financial institutions intermediate to those that need those resources. So, investable funds, those that have them, to those that need them, this is financial intermediation. Risk intermediation is those that are willing to take the risk, take it from those that are not willing to take the risk. So, once you use the keyword risk, the next keyword that immediately should spring in mind is insurance. Insurance. So, an important way to think about credit derivatives is about credit insurance. So, the idea of a credit insurance is that the risk of the credit instrument is being insured, probably by a third, completely independent party. Probably the risk becomes an instrument of itself. Literally a piece of paper, and that instrument can pass from hand to hand to hand. In other words, the risk itself may be bought and sold. So, this risk will have a price of its own. In other words, when I say this risk, I also mean this insurance. In other words, when you think of risk and insurance, it is logical. This is the nature of finance. The one bears the risk, and the other one effectively buys insurance. So when we say risk, we mean one sells the risk, the other one buys the risk. This is the exact opposite of one party sells insurance, the other one writes the insurance. This is related to the concept of so-called credit default swaps. I will have a separate lecture on this one too, so I already outlined about 4 or 5 different lectures that I'll be developing over the next 3, possibly most likely 4 lectures. So, let me see, do I have a credit default swap here? Let's see, credit default swap, yes. Credit default swap, this is a bilateral contract, meaning the contract between two different parties under which the two parties agree to isolate the risk, meaning the default risk of a specific instrument, of a specific bond, or of a specific credit, or of a specific loan. So, for that particular instrument, usually bond, could be, let's say, a mortgage bond, could be a, let's say, municipal bond, or any other corporate bond. So, what they agree is to swap the payments in case that there is a default. This is the same thing as the buyer of the credit default swap purchases insurance. So he simply gets an insurance that in case, for example, you purchase GM bonds and you get a certain return. If you additionally purchase a credit default swap on the GM bond, you are effectively buying a protection in case the GM bond goes bad, in some definition, that's part of that lecture. You will effectively get your money back from the insurer, the full principal of that loan that you agreed for, and the insurer will get the GM bond and do whatever he or she, meaning the financial institution, wants to do with them. So this is a classical insurance, and it's an insurance of risk. Alright, so I have the topic to discuss securitization versus pass-through. The difference is fairly straightforward. Securitization is one big giant pool. Everything is together and you're always getting your piece or your percentage out of the whole pool. The major difference with securitization is that this pool, better shown like this is the full pool, is split into parts, into different parts, and each part is called a tranche. Sometimes might be used as tranche, and each separate, sometimes it's called a layer, sometimes it is called a level, and the idea is that these layers and levels have, and the general concept for these is that of seniority. Seniority means that you first pay the highest or the most senior security. You pay what is being promised. If there is left, you fall through and pay the second most senior. Then you pay the third most senior. And if there is anything left, you pay to the lower and lower and lower tranches. These tranches have different names, and some in the middle are called mezzanine. Some of those at the bottom are called equity, and I will be explaining these in great detail in our securitization lecture. Now, how this works and how it's evaluated, there are a lot of terminology related to securitization that you have to understand. The key is that all of these CPDOs, CMOs, CLOs are part of the full securitization process. Now, all of these credit derivatives are part of the derivatives. You guys know about, probably, I hope, stock derivatives. So, there are stock derivatives, there are commodity derivatives, but these are dwarfed by the credit derivatives. Oh, well, there are also currency derivatives, but the credit derivatives are many times bigger, and therefore many times more important. So understanding what's going on with stock derivatives is good, is great, and this is what professors love for you to teach you, but they're not as relevant. They matter a little. Meaning, they are a drop in the bucket. The big bucket or the ocean is that of credit derivatives. So, you might understand stock derivative, and this is great for, classroom exercise. But if you want to understand the real world, you gotta know and understand credit derivatives. So, I'm trying also one lecture of these. I mean, that adds up to about 7 or 8 lectures anyway. So, the difference is that pass-through, there is no level of seniority. I'll be introducing, there's a big chunk of terminology, about 10, 20 fundamental concepts in securitization, but I don't want to go through these today. The idea to understand is this is one giant pool, and everyone is equal with everybody else. The difference here is that pool is sliced into different layers, and these guys do not get a penny until these guys get everything they're promised. So, these guys are, let's say, promised 4%. These are promised 5%. These are promised 6%. Until all of these guys, the top senior guys, the most senior guys, get all of their 4%, only then the second layer begins to get anything, if there is anything left. Alright? So, for example, if let's say 20% of those that compose the security do not pay and cannot pay and default, what really happens is only 80% of those people pay. The first layer will get paid in full, the second will get paid in full, the third will get paid in full, the second will get only half of what they were promised, and these guys get pure and absolutely nothing. Alright, so what this really means is that this slices the risk of the security, and some people bear very little to no risk, and some people at the very bottom bear an awful lot, if not the full risk. Alright, so that's the main difference. Alright, so credit default swap. Here is another one which just popped up recently, and it's called CPDO. CPDO. And CPDO is a constant proportion debt obligation. Until a few months ago, very few people even understood what was this about. Very few people in the world really learned what it was about. The essence, the short and intuitive way to think about CPDO is that it's a leveraged bet on a credit default swap. So, you have a credit default swap, you leverage. So, let me use this because I missed this little point. Credit default swap is almost all of the times shortened CDS. CDS. So, a lot of times when you read, you will pretty much be seeing CDS. A few times will authors write out explicitly credit default swaps. So, this is a leverage bet on CDS. So, what the idea here is that you will have some institution that will create a leverage bet. So, whatever the behavior of CDS is, if you're losing some, it will magnify your losses. That's what the leverage means. But it also means, if you're making some money, you will be making many more of it. Why is that? Well, again, this is a backtrack. Simply because Greenspan lowered interest rate rock bottom 1% or 2%. 1 or 2% does not satisfy any investor in the world. That's impossible. And this is the trouble with low real estate. People, of course, Wall Street and politicians love low interest rates. But there's a fundamental problem. Low interest rates do not satisfy investors. When investors aren't happy with low interest rates, they do one simple thing. They leverage them. And when you leverage them, you magnify your profits. You barely get 2 measly %. You leverage 10 to 1, and you get suddenly 2%, you get 20%. Of course, it works in reverse. When the credit crunch starts, you get wiped out in no time, you go bankrupt, and you can't pay the obligation, so the dominoes begin to fall. The guy can't pay the previous guy, so that guy goes bankrupt, this guy goes bankrupt, he owes to a third party, that also goes bankrupt. So the domino begins to fall and the whole financial system begins to fall apart as it is perceived today with a financial system. So, CPDOs, some mathematical wizard designed them to make more money on CDS, on credit default swaps. Well, they also get to work in reverse. You get to read about monoliners being loaded up on CPDOs and suddenly losing billions of dollars on them, alright? I'll be explaining in a minute what a monoliner is. So, that's a CPDO. You're not happy with the return, you leverage it. You make a lot more when you make. Of course, when you lose, you also lose a lot more. Alright, let's see what else do I have. Securitization, risk in disintermediate. So, what it does is moves securitization. The main idea of securitization is that you slice it through layers. Those that want safe securities buy the top tranches, alright? And those that want to bear the more risk, hoping for the higher return, will buy the lower tiers, alright, or the equity tiers. So the idea of securitization is you can slice the security just the way the investors want them and just the way they demand them. So essentially, this is what is called an example of financial engineering. Financial engineering is one of two things. You design the security either to fit well the demand, investor demand, or you design it in such a way so as to evade or avoid a restrictive government regulation. So this type of security is a type of financial engineering, and you can design these cutoff points a little bit higher or a little bit lower, or you may add some more intermediate layers just the way the investors want it. Alright? So these are relatively unique. Usually these tranches may work with a couple of billions so that the process is, pays off. In other words, you make a security that's worth 5 billion, you slice the tranches, and then you sell 1,000 of that billion into pieces to investors, whoever wants to buy. Alright, so let's see. Another major issue, let's say terminology to use. Let me wipe this out and start all over again on a clean slate. Is the concept of LBO. LBO, you should probably know. I expect that many of you have actually had a course in corporate finance. Corporate finance, that's a major subject, especially in intermediate, and it simply means leveraged buyout. Leveraged buyout simply means that when you have a company public, that is, its stock is traded on a public exchange, or that is publicly traded, at that point, a group of people, possibly managers, in other words, insiders, possibly outsiders, decide to buy out the company. That's why it's called a buyout. Well, how do they buy? They buy by borrowing money and paying out to existing shareholders. Well, when you borrow money, you effectively leverage yourself. So leverage effectively means borrowing, and borrowing essentially means the same as leverage. That when you profit, you magnify the profits, and when you lose, you magnify your losses. Alright? So LBO is a leverage buyout. Very common, very popular, known for more than a century, etc. Let me move on to the next concept, which is MBO. An MBO is a management buyout. A management buyout is an LBO or a leveraged buyout performed by the management of the company itself. So an MBO is an LBO by the insiders. So managers aren't happy with the company or aren't happy with the board or they believe that the stock is undervalued. They go to an investment banker. The investment banker says, sure, your stock is worth 30. The market values you only at 20. And we're going to give you $5 billion. Of course, the investment banker is going to make a fortune out of the fees and interest and everything else. So he will always advise that, and management would go ahead, borrow $5 billion, pay out all shareholders, and the company effectively becomes from public, turns into private. So that's the next thing that I'm discussing, is a concept called private equity. Alright, private equity is a misnomer where Wall Street tries to fool people into thinking that it's an equity. Private equity is essentially a fund, a firm, or a business which specializes in MBOs and LBOs. So this is a firm which usually makes public businesses private by borrowing money, usually from a bank. So instead of private equity, the true nature is private debt and private leverage. But private equity sounds nicer and also misleading to what the real nature is. But the nature of private equity is borrowing money to perform an LBO. Alright? So this is a firm. That firm will specialize, and that firm may have 20, 50, or even 100 LBOs to perform. So the firm is on the lookout to find a company. Okay, that's a good target. And the private equity firm will find financing and perform an LBO and take the public company private. So essentially, private equity, the best way to think about is a firm that specializes in LBOs by taking the company or making them private and their own by means of debt and borrowing. Alright? So that's private equity. And I'm also done with the section of some structured finance terminology. Well, structured finance, you must understand, never can possibly work in an environment of a vacuum. It needs to get financed somehow. So, the best way, or one of the ways to finance, is through money market instruments. Now, in money and banking, or let's say money and capital markets, we usually study roughly about 10, 12 different money market instruments. Here the idea is not to study all instruments, but to study those instruments that were instrumental in blowing out the mortgage boom and then turning into a bust and crisis. And I have outlined, number one, they just write it as CP. They just short it as CP, which stands for commercial paper. So, a commercial paper is simply a debt instrument. Short term, I probably should define that all money market instruments are short term, usually by convention of maturity less than 1 year. So commercial paper is a short term financial instrument. issued by a business, firm, or other non-bank institution. Non-bank institution, could be corporation, GM, or whatnot, to finance itself. So, usually these different vehicles that they use, they simply issued commercial paper. In other words, they simply borrowed short term. Another variation of this is ABCP. Again, most often than not, you'll just see it as ABCP. And ABCP is asset-backed commercial paper. So, this is commercial paper backed by specific asset. Well, that specific asset might be a bond, might be mortgages, might be other stuff. So, there's a financial institution or entity, and that entity itself will issue commercial paper, and that commercial paper will be backed by some sort of asset. I mean, what that might be is a different story. So, essentially, this is some sort of an asset-backed security, okay? But this one is certainly short-term. Alright, then we have MMF. MMF is money market funds, and authors like to sometimes say money market funds, sometimes they say money market mutual funds. So, I have seen authors use these quite interchangeably, practically meaning the same thing, money market fund and money market mutual fund. So this is essentially an instrument sold by a financial institution which buys only high-grade short-term securities. So they usually buy pretty much government securities. 1 month, 3 months, maybe 6 months, maybe up to a year. They buy very high-grade corporate securities. For example, GE, General Electric, is a fairly safe, good, high-quality company. So, if it issues some sort of a commercial paper, some loan, the money market mutual fund will buy that security. So, the money market mutual fund itself will issue its own shares, that's how they're called, shares, and you can buy simply a money market mutual fund shares. And you know that the money market mutual fund is invested in very high grade, top quality securities. Well, just recently, in the last couple of months, was realized that the money market mutual funds did not invest all in perfectly safe and secure securities. Instead, they invest in a lot of risky securities. So now there is some concern that money market mutual funds aren't that safe as it has been believed so far. Alright, the next one is also very common, very popular, Repo. This is a repurchase agreement. This should be understood pretty much by every student. Pretty much any one of us introductory macro professors teach what a repo is. It is simply a repurchase agreement where there is a sale of a security, usually a high-grade corporate or most often a high-grade government security, with the immediate arrangement to buy back that security at some later time, usually in a short period of time. 1 week, 2 weeks, maybe 1 month. And oftentimes the other party in that repo deal is usually the central bank. So, central bank will usually use repurchase agreements also as a tool of monetary policy. So, central bank will often be, but it does not have to necessarily be, the other side of a repurchase agreement. The repurchase agreement is its essence in that of a short-term loan secured by the particular security that is sold and bought back. So that's what a repo means. And there is another one which is very popular. It is simply called Fed funds. Fed funds is a market, and Fed funds essentially is a loan of one commercial bank to another commercial bank, usually made for the purposes of satisfying minimum reserve requirements. So that's what Fed funds is, and the Fed funds market is essentially the interbank market where banks, commercial banks, lend to other commercial banks. In other words, they lend to each other short terms, and often it might be even overnight. It is not necessary to be overnight. It could be for 1 week or for any other number of days, 10 days, 3 days, whatever, but it's most often overnight. So these instruments were essential. These instruments were essential in driving the boom before, in other words, the credit expansion that preceded the crisis and the current, some sort of credit contraction. Alright, so let's move on to the next topic, and the next topic is institutions. Alright, so the first institution actually has 3 different variations. The first variation is SPE, SPV, and let me see what's the third one that I have, SPE, SIV. So the first one is special purpose entity. Special purpose entity. This is an entity which is designed to have a separate legal status. Usually all these 3 will have what is called a sponsor. A sponsor is a financial institution that creates it and backs that special purpose entity. It is legally separate from the sponsor. The idea is that by the legal separation, the risk that happens in the special purpose entity, and if there is trouble, you cannot get to the sponsor. So Merrill Lynch or Citigroup or Bear Stearns will have its own special purpose entity, and that special purpose entity will have some special purpose. That's the idea. Instead of special purpose entity, sometimes it is called special purpose vehicle. I have not been able to find any meaningful difference between these two. I've tried and researched the topic. So, how are they different? So, what I have found is that mostly SPE, special purpose entity, is usually a US usage. So, usually this is the preferred way to use in the United States. And SPV seems to be more of European and British usage. So in Europe they more call it the SPV, while in the US it's called SPE. And then we get to why during the current credit crunch you had SIV, which is Special Investment Vehicle. So now this is more again a US. Again, you must understand, this is the SIV is the instrument of this boom, and the instrument that is going now, meaning the institution that is going now bankrupt, and essentially has no difference from the other 2. Why then the different name if it has the same meaning? The answer is Enron. Enron used an SPE, special purpose entity, to do its dirty little tricks, and it was supported by what was the accounting institution that effectively was shut down, right? So they used the SPE, and everybody understood, you know, since it was just barely 5 years ago, that SPE is a dirty word, and it's a dirty little institution, usually designed to do dirty things, meaning not good, right, or appropriate things. So, if you use SPE, oh no way. So what do? You use the same legal principle, use the same laws, you just change the name from SPE to SIV and fool the others that it is different when its nature is in reality not. So it's just another different name for the same concept as SPE and SPV. So SIVs were instrumental in blowing and blowing and blowing the boom. Alright, let's see what else do I have. SP, okay, another concept of or another institution is GSE. GSE stands for Government-Sponsored Entity. The US federal government loves to sponsor entities. It has a whole alphabet soup of its own with those entities. So this is a financial institution, possibly a bank financial institution, possibly a non-bank financial institution, which the government somehow sponsors or even backs, sometimes explicitly with a law, sometimes with an implicit guarantee. So these GSEs will be, one of the most prominent one will be what is known as Fannie Mae. So Fannie Mae is one of those government-sponsored entities known as GSEs, and it is as if Fannie Mae goes bad or bankrupt, the government will definitely support it, meaning bail it out. So Fannie Mae has been also to a great extent instrumental in this crisis, as have been many other institutions, GSEs. Another example of a GSE is FHLB. This is Federal Home Loan Banks. It is a system designed many years ago in the aftermath of the Great Depression to finance and support real estate when real estate prices were collapsing during the Great Depression. And it has now been again instrumental over the last couple of months, maybe since the August crisis, in absorbing or continuing to finance the real estate market. You will be getting to read more somewhere around the middle of the semester about the FHLB's role in this credit crunch, in the saving the current crisis. So, current crisis has been really bad. But if it wasn't for FHLB, it would have been way, way, way worse. Alright? So you gotta understand that part. Next one is another which should be fairly familiar. Again, I'm all trying to do is just survey the different institutions. FDIC. This is the Federal Deposit Insurance Corporation. This is practically a government-sponsored institution, another type of a GSE. It's a government-sponsored institution which insures commercial banks' loans. Sorry, deposits, my mistake. So, if you put in your money in a bank one, or whichever bank you go when you go in the United States, you want it to be FDIC insured. This means if the bank goes bankrupt, the FDIC will come along and will guarantee your deposit, at least up to a certain amount. Usually, at least in the United States, it's $100,000. For Bulgaria, I think it's like now 20,000 euro, whatever. So FDIC means it instills confidence in people so that people are not afraid in their afraid of losing their deposits in the banks. So the FDIC essentially is one of the government's instruments to prevent bank runs, or at least avoid them. And even if you don't have an FDIC, meaning deposit insurance, in Great Britain, depositors nevertheless say, great, even though the government insures my deposit, I'd better just go to Northern Rock and get my money out anyway. They will be safer elsewhere. So that's another of the institution. Another institution is monoliners. I mentioned them. A monoliner is also known as credit insurer. Credit insurer, let me write it out. credit insurer, and is also known as, let's put in here another arrow, debt guarantor. And you should immediately see it. So monoliner is the same as credit insurer, is the same as debt guarantor. So this is a financial institution that guarantees debt, that provides insurance for debt. You say, well, wait a minute. Wasn't that what the, let's see, oh, I already deleted it, the credit default swap was about? The answer is yes, it is the same thing. The credit default swap is the instrument in insuring credit, and this is the institution. So, you have a business, and the business is called monoliner. The main piece of paper, document, is called credit default swap. So, monoliners are in the business, effectively, of credit default swaps, alright? So, monoliners are the key, the pivotal institution. Let's call it the crucial institution in this whole blowout, because they instilled confidence in the credit system. Just like the FDIC instills confidence because of its guarantee in the deposits in commercial banks, the monoliners instill confidence in all other corporate debt, municipal debt, and all of those other different instruments, so they insure everything. Here is the key. If and when a monoliner goes bankrupt and it insures trillions of dollars, from there begins the whole pyramid to fall. So you gotta understand this whole thing is one big pyramid scheme, and the monoliners are the critical, the crucial component. They hold this whole piece together. If you get to mistrust the monoliners, the whole system collapses, and it collapses real fast. We're now in the process of shaking confidence, in the shaking confidence of these monoliners. Alright? So, now is the process of unraveling of monoliners just this month. So, this is the big issue in these financial markets. Alright, this is on institutions, and I have barely 5 minutes to explain roughly some mortgage mumbo-jumbo. So, what is some mortgage terminology? Because there were literally dozens of different variations of mortgages. The first variation of a mortgage is prime subprime. A prime mortgage is a mortgage that is given or underwritten for a high, top quality borrower. Subprime is a mortgage given to a borrower who has less than perfect credit. Maybe he had the bankruptcy before. Maybe he defaulted on previous loans. Maybe he missed a bunch of payments on his credit cards or student loans or something else. So this guy is definitely not a good borrower. He is what we call high risk. So prime means good risk, means low risk. Subprime means high risk. The second version is another variation is so-called liar loans. A liar loan is a mortgage loan given entirely on what the borrower says he has in terms of what his income, what his wealth is, without verifying his income. So, liar loan is the same as what is known as no-doc loan. No-doc is simply short for no documentation loan. In other words, you go, you buy a house, they give you $400,000 loan in California, and you don't submit a single document of whether you have any credit or not. They just give it to you. So this is a variation, no-doc. Now, another loan is called no-am. And no-am stands for no amortization loan. No amortization loan is principal only. Principal only loan is when you borrow the money, all you pay is, interest only. My mistake, sorry guys. Interest only. Your payments include only interest and you do not pay down the principal. So this is what's called interest only loan. Alright? Then there is so-called neg-am. Neg-am standing for negative amortization loan. A negative amortization loan is simply a loan whose monthly payment is less than the interest rate. So you accumulate your interest in the principal. So you have $100,000 loans, your interest is 5%, you pay only for the 1%, you add up on top of the principal. So rather than paying down the principal, your principal goes up. In Bulgaria, these types of loans are strictly illegal. In the US, it's okay. They were used massively in the Californian real estate bubbles. Alright, there's two more is ARM. An ARM simply is an adjustable rate mortgage. Adjustable rate mortgage means that the interest rate of your mortgage fluctuates with some benchmark. That benchmark may be the Fed funds. More often that benchmark will be the LIBOR. So whatever the benchmark floats, your interest payment will be a markup, maybe 50 basis points, maybe 150 basis points on top of that ARM. Alright, so that's an ARM, also an instrumental. And finally, there is what's called a private label MBS. So this is a mortgage-backed security which is issued, private label, by an Wall Street investment bank. Maybe Merrill Lynch, maybe Citigroup or some other institution. So this is the beginning of my topic, and as far as I'm concerned, I am done with the lecture part for today. Alright.